Rushanara.
Thank you very much. I've got some questions on saving rates. So obviously there's been some activity from the FCA. I would have hoped it came sooner, but better late than never. We have seen some rates on instant access savings still below 1%. Do you think it's acceptable that that's the case given the base rate is now at 5%?
As you say, we've been raising this issue publicly since May last year, and I made a very forthright statement in a media interview in October last year. I spoke at the UK Finance Annual Dinner in November.
Why didn't they listen to you?
And the pace has been slow. We have the consumer duty coming into force, and you've seen, I think, in the last few weeks that pace has quickened. I looked at the data just 2 days ago. There are 20...
Sorry, can I just check? You're waiting for the consumer duty before banks will act. Do you not have any powers to ensure they act now?
Our powers relate to competition in the market.
Yeah.
We have powers to make sure that there is effective competition,
yep.
And that's what we have been focusing on. The consumer duty goes further in extending the way in which we look at this to how they are communicating with their consumers, how they are ensuring good outcomes for consumers. When I take that first dimension of competition, as of 2 days ago, in the instant access market, there were 53 accounts available greater than 4%, 2 greater than 5%, and 227 greater than 3%, and that's a total of 520
but the
accounts.
rates I'm looking at, the current rates for Lloyds Bank Early Saver account 0.9% for up to 25,000, NatWest Flexible Saver 1.4%, Barclays Everyday Saver 1.5% up to 10,000, HSBC Flexi Saver 1.75%, Virgin Money Everyday Saver 0.25%, TSB Early Saver 1.1%, including 0.1% bonus, which is just for the first year, which is frankly insulting. Nationwide Instant Saver 2.15% for up to 10,000. The list goes on. So I appreciate you've just picked out an example that's much higher, but these are pretty poor, wouldn't you say?
I would say that we have a long-standing position in our market where the best rates you tend to get from the building societies, the digital and challenger banks are close behind, and the high street tend to provide the lowest rates. Now, we're not a price regulator. We don't go in and set prices, but we want to make sure that customers understand what options are available, that where a bank is delivering a better rate, that they are proactively communicating with their customers. We have seen in the last few months a significant shift of about 8% into term deposits. We are seeing current account balances come down for different reasons.
Just a broader question about interest rate rises. Obviously, the Bank of England has had to necessarily increase interest rates given the inflation rate. Do you think the fact that banks who are making, some estimates suggest £7 billion in terms of profits from the rate rises and not passing them on, large-scale profits, some between 34 to 37,000 last year. Do you think that their inaction in passing on savings is acting as a blunting instrument on the Bank of England's attempts to try and bring inflation under control? Is there a risk that, because there are fewer and less, the incentives are lower for saving, and don't forget, during the pandemic, savings went up for those who are better off, who couldn't spend their money. So do you think there is an issue that the fact that we haven't got banks passing on savings is actually undermining the overall economic objective of trying to buy the bank to try and bring inflation under control, but notwithstanding the other issues that this country is facing in trying to bear down on inflation that are particular to this country alongside the wider patterns that other countries are facing? Could both of you comment on that, please?
Given the inflation numbers are out this morning,
That's a cop-out.
No, I haven't answered the question
higher.
yet. I haven't answered the question. So the Bank of England has commented in their previous minutes around the level of pass-through and the importance of pass-through. It wouldn't be appropriate for me to go beyond that because obviously they're responsible for the inflation target. What I said in my speech in November, if you look back at it, was that the way that banks handle this period, both in terms of supporting vulnerable customers and customers who are struggling, and savers, which was specifically called out, will be very deterministic of their reputation for many years to come. We were highlighting that issue earlier, and I would agree with you that the pace has simply not been been fast enough. We have stepped up our engagement. We were always expecting, as the consumer duty comes into force on the 31st of July, that the pace would accelerate. There's also an important, when you talk about this sort of macroeconomics, there's also an important point around composition of savings. You're right that during the pandemic, a lot of consumers accrued savings, particularly in their current accounts. And because we've had a period of such low interest rates for a long period of time, the habit of switching eroded somewhat. That is coming back now. Okay. That is coming back. People are starting to move. People are moving into term deposits, which is better for the stability of banking books, to the extent that people are able to do so. Instant access rates are moving up. And my advice to consumers would be to shop around. And if your high street bank is not giving you a rate that you are satisfied with, move on.
Thank you. I've got quite a few questions, but I just wanted to bring in our new chair. Welcome.
Also new.
Relatively new chair. What are your thoughts on this? And do you think it's acceptable that the banks are behaving like this, given that the taxpayer bailed them out in 2008 during the global financial crisis? And what are you going to do about it?
I think actually one of the main issues here. I mean, I've seen what the banks have said about the factors they take into account on savings rates. To me, one of the key issues, given that we do not set prices, we don't set rates, is the degree to which. Actually, I'm just going to look at Nikhil's letter of the 14th of July. Actually, if you look at the, I think page 3 of that, one of the factors that we will look at in our reviews of a firm's fair value assessment of rates is the cost to banks of providing savings products and the margins that banks earn on the provision of those products. So that's relevant. Mm-hmm. I think one of the other key factors in relation to this does relate to new consumer duty, and an important aspect of that is an expectation on banks that they very quickly bring consumers' attention to better rates, putting it simply, and we would expect that to be done.
So do you expect this issue to go away as soon as the consumer duty comes in? Do you? I think what can we expect to see with this new consumer duty that is going to change the landscape to such an extent that we're not going to be so concerned? Because I do have concerns about the transmission point. I think lots of people do. And banks obviously are benefiting from rising interest rates, while the people are suffering in terms of mortgage rates as well as inflation. Inflation it's going to take some time to bring it back to target, and interest rates are likely to continue. So what can we expect to see with the consumer duty? What's the trajectory in terms of timeline as soon as it comes in? Because I'm a bit concerned that people are sort of hiding behind the consumer duty and then the feed through in terms of consumer duty to see results.
What I'd expect to see, and we'll be providing a report, and we'll share that, of course, with the committee at the end of the month. What I'd expect to see in the coming months is non-interest-bearing current account balances across the market to come down, partly because people are paying down debt, partly because of the inflationary pressures that families are feeling, and partly because people are moving towards savings. Overall, as an economy, we have too much money as consumers in non-interest-bearing current accounts, and people need to move that money into savings accounts, and we hope that will happen in the coming months. Secondly, I think you will start to see, as is already happening at quite some pace, moves towards fixed-term deposits. Historically, 40% of the £1.5 trillion consumer savings market was in notice or fixed-term deposits. At the moment, it's about 18%. There are over 1,500 rates available now greater than 4% in fixed-term deposits, 500 greater than 5%. You're starting to see that move. That is happening, and that is accelerating as people are adjusting. We also will be looking at further measures that we can take to further improve competition. You saw the letter with the Information Commissioner. The Treasury is looking at the ring-fencing threshold, which might provide some competitive impetus, and also the deposit protection work that the Treasury and Bank of England are doing is also relevant.
Do you think there's a case for a savings charter along with the mortgage charter? And you mentioned data protection, so we should expect that there won't be any obstacles to banks contacting consumers about better saving rates?
I don't believe there were obstacles. since I've been at the FCA, I've always talked about
partnership. Were they made
partnership.
up by banks then?
They have their advice and they made their points. We responded very firmly 2 days ago, and
is it right that banks are behaving like this? It does feel like they're taking the public for a ride, using excuses like that in order to not offer customers, proactively offer customers different rates. Are you concerned about that sort of behaviour in the banking sector?
I don't think that it was a particularly convincing set of arguments around data protection, and we made that very clear and very publicly so.
On savings charter?
I am less keen on a savings charter. I think the mortgage charter is different because that is about how you treat customers in difficulty, vulnerable customers. Mm-hmm. In savings, we want a vibrant, dynamic, competitive market where people are competing with each other to win business off each other.
They seem to be quite dynamic in not passing on with respect to the rates, though.
We have to be quite careful about seeking to coordinate pricing decisions in that market, because we have got a reasonably competitive market, and we want to make sure that is functioning effectively. I do think there's a bigger issue about savings, though, and that is the Chair touched on it in terms of productive finance and allocating UK savings to supporting the UK economy. So we're talking here about the cash savings market. The Treasury's put forward some proposals around bond markets, making it easier for retail investors to access corporate bonds. And now we can move away from EU rules, so we can bring the denomination down. We'd like a more vibrant market there. We'd like to see more people investing in long-term infrastructure and in equities too.
Okay, but just on savings and what customers can, transparency around what customers can expect and what they can go and talk to their banks about. Do you think there is a case for something that puts in one place like the mortgage charter does? Because people can't see the wood for the trees at the moment, and you picked a number that was much higher. I gave you about 8 that were much, much lower, and we spend a lot of time thinking about this stuff. Is there something you can provide to customers like a mortgage charter, like equivalent to the mortgage charter, where it's very clear what the expectations are? Like this point about if banks say they would have done, we can't offer mortgage. We can't offer better savings rate because of data protection. Well, if they use these spurious excuses, what should they expect? There's a lack of transparency here, and it's costing people, and it's impacting the economy. And you're the regulator.
I think just to keep this very relatively straightforward, I think the expectation, from my perspective, is you do not take advantage of consumer inertia. You don't do that.
Well, they are here. They clearly are, and not enough is being done about it.
So in terms of what the expectations of banks are, I think Nikhil's letter of the 14th actually set that out pretty clearly. So I think if a bank picked up that letter, read it, understood it, the expectations are very, very clear, including the point around proactive engagement with consumers so they are able to switch.
These rates
really
are today's rates, the ones I read out. So I can't see how much of a difference it's made receiving the letter from the chief exec of the FCA. And I'm concerned about that. I'm concerned that they are taking the biscuit, and something needs to be done about that.
We will publish the data as to what's happened, and I think overall, in aggregate, there has been movement up of the rates. We talked about what the benefits of the consumer duty may be, and it's very hard always to prove causation, but with £1.5 trillion of savings in the economy, if even there's a 0.1% adjustment in the rate, that's over £1 billion accruing to consumers. You will have seen, in terms of the explanations to consumers, we have worked to simplify, and banks have worked to simplify their ranges, which I think is positive. They've also started to stop differentiating between front and back book. There's one very important point I want to make, though, is about diversity of business models. We will have building societies, for example, that will have a different business model to banks. So some will have savings rates which may look low on the surface, but then they pay the money back as member dividends, or they commit to keep their branches open. So whatever we do here, we want to make sure we respect the diversity that we have in the market, including in the mutuals sector.
Thank you very much. Do you want to come back later?
Come back later.
Yeah, okay, brilliant. Angela.
Thank you.